In this TaxSlayer Pro presentation, we're going to look at the new tax law for 2018 and how it might affect you and your tax clients. We're going to look at 6 different scenarios under the Tax Cuts and Jobs Act and see how it might have an effect on each of these taxpayers. Changes are coming in 2018. Most of us will pay less in taxes in the next few years thanks to lower tax rates and higher standard deductions. But the loss of some prized tax breaks and new caps on others like state and local taxes could result in higher tax bills for some older taxpayers, especially those who live in states with high tax rates. Over time, some of the benefits of the new tax bill will fade away. Experts project that a majority of taxpayers will pay more within 10 years. Let's look at scenario number 1. An older couple. John, 67, and Susie, 63, still have a mortgage on their home. He's retired and pulls in $17,000 from Social Security. She still works, earning $50,000 a year. Both are relatively healthy, and Medicare and her work insurance cover most of their medical bills. In 2017, they claimed $13,000 in itemized deductions. $5,000 in real and personal property taxes, $5,000 in mortgage interest, $2,000 in state and local income taxes, and $1,000 in charitable donations made up their $13,000 in itemized deductions. The 2018 result: federal taxes will go down by $1,114 on their tax return. So what changed? Higher standard deductions eliminate their need to itemize. John and Susie have a new standard deduction worth $25,300, comprising $24,000 for couples filing jointly, and John's extra $1,300 deduction because he's over 65. The couple can no longer claim $8,100 in personal exemptions, but that figure is offset by the couple's higher standard deductions. Scenario number 2. Small business owners. Robert and Susan, both 41, own and run a small business and file jointly. The couple have net business income of $100,000, and they own a home that they're working to pay off. In 2017, they claimed $20,000 in itemized deductions, $7,000 in personal property taxes, $8,000 in mortgage interest, $4,000 in state and local income taxes, and $1,000 in charitable donations made up their $20,000 itemized deduction figure. The 2018 result: federal taxes will go down by $2,554. What changed? Their standard deduction nearly doubles. The new tax bill boosts the couple's standard deduction to $24,000, up from $12,700. That exceeds the $20,000 in itemized deductions that they took on their 2017 tax return. Their tax rate also falls. The couple were in the 25% bracket in 2017. Under the new tax law, they're in the 22% tax bracket. They benefit from the new qualified business income deduction of 20%. Their qualified business income is $100,000, which is net income from their shop, and their taxable income before accounting for this deduction is $68,935. This means they qualify for a deduction of $13,787. This deduction does not lower their self-employment tax, however. Scenario number 3, a family in the Burbs. Julie and Nick are married and have 2 children, a son in college and a daughter in high school. They own a home, both still work. Their combined wages total $150,000. In 2017, they claimed $22,000 in itemized deductions. $4,000 in property tax, $8,000 in mortgage interest, $7,000 in state and local income taxes, $2,000 in charitable donations, $1,000 in personal property tax, which consisted of auto tags and so on. The 2018 result: federal taxes will go down by $2,577. What changed? Their standard deduction nearly doubles, but their exemptions go away. The new tax bill increases Julie and Nick's standard deduction to $24,000, up from $12,700. Nick, 66, also gets the extra $1,300 standard deduction available to filers 65 and older. However, the couple loses $16,200 in personal exemptions that they took on their 2017 tax return. The net effect? They pay taxes on a larger amount. However, their tax rate falls. The couple were in the 25% bracket in 2017. Under the new tax law, they're in the 22% tax bracket. They no longer need to itemize their deductions, since their standard deduction is higher than their itemized deductions of $22,000. They can take advantage of the child tax credit. The new tax law raised income limits on families claiming the CTC and raised the level of the credit from $1,000 to $2,000. They can also get a $500 non-child dependent credit for their son, claiming a total of $2,500 in child tax credit. Scenario number 4. A couple strapped with medical bills. Deborah and Michael, both 66, pay $3,000 per month to cover medical expenses using a home equity loan on their home. They have $30,000 in Social Security income, and they pull in another $50,000 from a private pension. In 2017, they claimed $40,975 in itemized deductions, consisting of $30,975 in medical expenses, the maximum allowed after applying the 7.5% AGI floor. $5,000 in interest from a home equity loan, $4,000 in real estate and personal property taxes, $1,000 in state and local taxes. 2018 result: federal taxes will go up by $1,549. What changed? Under the new tax law, the couple lose two significant tax breaks. They can no longer write off the $5,000 in home equity loan interest. They also lose $8,100 worth of personal exemptions. Those changes mean their taxable income increases by $13,100. Scenario number 5. The Southern Widow. Donna, 71 and retired, lives alone in a condo she owns, but has a second mortgage that she uses to pay for splurges and for doctor bills. Each month, she receives Social Security benefits of roughly $1,400, pension payments of just over $4,100, putting her annual income at $67,000. She claimed itemized deductions totaling $16,166 in 2017. These consisted of $5,166 of her $10,000 in medical expenses, because she could deduct only the amount in excess of 7.5% of her adjusted gross income, $3,000 in mortgage interest, $4,500 in real estate and personal property taxes, $2,500 in state and local taxes, and $1,000 in charitable contributions. 2018 result: her federal taxes will go down by $233. What changed? Donna loses her personal exemption of $4,050. She's in a lower tax bracket. While she doesn't benefit from the new higher standard deduction, since her itemized deductions exceed the standard $12,000 plus $1,300 for people 65 and older. The new law puts her in the 22% tax bracket in 2018, down from the 25% bracket in 2017. Scenario number 6, the Atlanta executive. Raymond is a single man living in a condo he owns in downtown Atlanta. Last year, he earned $500,000 as a senior vice president and claimed $135,000 in itemized deductions. $55,000 mortgage interest, $46,000 state and local income tax, $24,000 real and personal property tax, $10,000 in charitable contributions. The 2018 change? His federal taxes will go up by $6,396. What changed? His biggest tax deduction goes away. Under the new tax bill, the deduction for all state and local taxes, or SALT, is limited to $10,000. Raymond's SALT total, which includes both income and property taxes, is $60,000 over the limit. So his overall itemized deductions drop by that amount to $75,000. His personal exemption also goes away. Under the new law, the personal exemption was eliminated. That increases Raymond's taxable income by $4,050 in 2018. His tax rate also goes up. Tax rates were reduced under the new law, but in Raymond's case, the loss of $60,000 in SALT deductions pushes him into a higher tax bracket. The top rate he'll pay on some of his income is 35% compared to 28% in 2017. Bottom line, the new tax legislation will affect different people in different ways. We want to thank you for watching this TaxSlayer Pro presentation on the 2018 tax law and how it will change things for you and your tax clients.